Welcome back to XRP Economic Radar, your trusted source for the latest developments shaping the crypto market, digital assets, and global financial trends. Today we are taking a close look at a major market event that sent shockwaves across the cryptocurrency industry. Bitcoin suddenly plunged below the critical $60,000 level, leaving investors searching for answers and wondering whether this was simply another emotional sell-off or the beginning of something much bigger. According to a new analysis from crypto exchange Bybit, the answer is much more complex than many people initially believed. Their latest report suggests that this dramatic decline was not caused by random panic alone. Instead, it was the result of several powerful market forces building pressure over weeks before finally triggering one of the most significant breakdowns of this crypto cycle. As we break down the details, you'll see why analysts believe this move could have major implications for Bitcoin, Ethereum, and the broader digital asset market moving forward. The report from Bybit focuses on what happened during the week ending June 8th, when Bitcoin experienced its sharpest weekly percentage drop since the collapse of FTX back in November of 2022. During that period, Bitcoin fell from approximately $73,760 to nearly $59,130. That decline caught many traders off guard because Bitcoin had been showing remarkable resilience for months. While buyers eventually stepped in and helped push the price back above $61,000, the damage had already been done from a technical perspective. According to analysts, the sharp drop revealed weaknesses that had been developing beneath the surface for some time. Rather than being a sudden emotional reaction from investors, the decline represented a structural breakdown that finally became visible after weeks of increasing market pressure. This distinction is important because structural issues often take longer to resolve than temporary panic-driven corrections. One of the most striking findings in the report involves technical indicators that measure market momentum and investor sentiment. Bybit highlighted that both Bitcoin and Ethereum reached some of the most extreme oversold conditions ever recorded during this market cycle. Ethereum's Relative Strength Index, commonly known as RSI, dropped to an astonishing reading of 12.78. For context, RSI is a widely followed indicator used by traders to identify whether an asset is overbought or oversold. Readings below 30 generally indicate oversold conditions, so a reading near 12 is considered extremely rare. At the same time, Bitcoin's RSI plunged to approximately 15.45, also signaling extraordinary selling pressure. Together, these numbers created what analysts described as the most oversold signal seen throughout the current crypto cycle. Such extreme readings suggest that investors were selling aggressively, without paying much attention to valuation or price levels, creating a broad market capitulation event. Market capitulation is a term that describes a situation where fear becomes so intense that investors rush to sell their positions regardless of price. During these moments, emotional decision-making often replaces rational analysis. Bybit's analysts noted that the behavior observed during this decline fits that description closely. Traders appeared willing to exit positions at almost any cost as concerns about the market continued to grow. Historically, oversold conditions of this magnitude have often been followed by relief rallies or technical rebounds as bargain hunters step in and short sellers close positions. However, the report cautions against assuming that a rebound automatically means the market has found its ultimate bottom. While oversold signals can indicate that selling pressure has become excessive, they do not guarantee that all downside risks have disappeared. Investors who mistake a temporary bounce for a confirmed trend reversal can sometimes find themselves caught in another wave of volatility. Another important factor highlighted by Bybit was the activity occurring within the options market. Following the confirmed technical breakdown, demand for protective put options increased significantly. Put options are commonly used by traders who want to hedge against further declines or profit from falling prices. At the same time, the Deribit Volatility Index, known as DVOL, surged dramatically. This index measures expected future volatility for Bitcoin and Ethereum options and is often viewed as a forward-looking indicator of market uncertainty. Before the sell-off, DVOL had been sitting near historic lows around 35. As the market declined, the index rapidly climbed to approximately 55. Such a move reflected a sharp increase in fear and expectations for larger price swings. Rising volatility combined with falling prices created an especially favorable environment for bearish traders who were positioned for downside movement. What made this volatility spike particularly significant was the way it amplified the profitability of bearish positions. Traders who were betting against the market benefited not only from declining asset prices, but also from rising implied volatility. This combination effectively created a double advantage for downside traders during the most intense phase of the sell-off. However, Bybit noted that conditions have started to stabilize somewhat since the initial shock. The DVOL index has retreated from its peak and is now hovering closer to 48. While that level remains elevated compared to previous weeks, it suggests that the most intense phase of panic may be fading. The reduction in volatility indicates that traders are gradually absorbing the shock and becoming more comfortable with the new market environment. Nevertheless, analysts caution that stabilization does not necessarily mean recovery, especially if other fundamental pressures continue to weigh on the market. Beyond technical indicators and options activity, macroeconomic developments also played a major role in triggering the decline. According to Bybit, stronger than expected employment data from the United States reignited concerns about future interest rate policy. In traditional financial markets, strong economic data is often considered positive news. However, in the current environment, many risk assets have become heavily dependent on expectations that central banks will eventually lower interest rates. When employment numbers come in stronger than anticipated, investors begin to worry that policymakers may keep rates elevated for longer periods. Higher rates generally make riskier investments less attractive because safer assets such as government bonds become more competitive. As a result, what might normally be viewed as encouraging economic news can actually create pressure on cryptocurrencies and other speculative assets that have benefited from hopes of future monetary easing. The labor market data effectively challenged the narrative that rate cuts could arrive in the near future. Analysts explain that every strong employment report now has the potential to create negative sentiment within risk asset markets. Investors who were positioning themselves for a more accommodative monetary environment suddenly found themselves reassessing those expectations. This shift in sentiment added another layer of pressure at a time when technical indicators were already weakening. As concerns about interest rates intensified, market participants became increasingly cautious, contributing to the broader wave of selling. The timing of these macroeconomic developments could not have been worse for Bitcoin, as they arrived precisely when the market was already showing signs of vulnerability. The result was a convergence of technical weakness, macroeconomic uncertainty, and investor fear that ultimately accelerated the decline. Another surprising development discussed in Bybit's report involved Strategy and its Bitcoin holdings. For years, many investors viewed Strategy as one of the strongest institutional supporters of Bitcoin. The company's commitment to accumulating and holding Bitcoin helped reinforce confidence among long-term believers in the asset. However, the report noted that Strategy sold 32 Bitcoin for approximately $2.5 million, a move that challenged the widely accepted belief that the company would never sell any portion of its holdings. Although the amount sold was relatively small compared to Strategy's overall position, the symbolic impact was much larger. Market participants interpreted the sale as a potential shift in narrative, creating concerns about whether other long-held assumptions within the crypto ecosystem could eventually be questioned as well. Even though Strategy later resumed purchasing Bitcoin, the initial sale still generated unease among investors. The concern was not necessarily about the value of the transaction itself, but about the message it appeared to send. Markets are often driven by confidence, and when a highly respected participant takes an unexpected action, traders frequently reassess their assumptions. Bybit's analysts emphasize that investors remain sensitive to these kinds of signals, particularly during periods of heightened uncertainty. Combined with ETF outflows, weakening technical conditions, rising volatility, and macroeconomic concerns, the sale added another layer of doubt to an already fragile market environment. While none of these factors alone may have been sufficient to trigger such a dramatic decline, their combined effect created a powerful catalyst that pushed Bitcoin below the psychologically important $60,000 threshold. Looking ahead, Bybit believes investors should remain cautious despite the extreme oversold conditions currently visible across the market. The report stresses that neither Bitcoin nor Ethereum has yet confirmed a bullish reversal. While historical patterns suggest that oversold markets often experience rebounds, confirmation of a sustainable recovery requires additional evidence. Analysts are closely monitoring whether spot Bitcoin ETF outflows begin to stabilize and whether broader macroeconomic conditions improve. Until those factors show meaningful progress, uncertainty is likely to remain elevated. The market may have absorbed the initial shock, but the underlying issues that contributed to the decline have not fully disappeared. For traders and investors, this means balancing optimism about potential recovery opportunities with a realistic understanding of the risks that still exist beneath the surface. As always, the crypto market continues to evolve rapidly, and the latest move below $60,000 serves as a reminder that major price swings are often driven by a combination of technical, macroeconomic, and psychological factors rather than a single headline. Bybit's analysis paints a picture of a market that was already under significant pressure before the decline became visible to everyone. Whether this proves to be a temporary correction or a more prolonged adjustment remains to be seen, but one thing is clear: understanding the forces behind these moves is essential for navigating today's digital asset landscape. Thank you for watching XRP Economic Radar. If you want more news, updates, and in-depth coverage on Bitcoin, XRP, and the cryptocurrency market, be sure to subscribe to XRP Economic Radar, like and share this video, and leave a comment below with your thoughts on where Bitcoin goes next. We appreciate your support and look forward to bringing you more important crypto updates very soon.